This week on the Retirement Quick Tips podcast, I'm talking about navigating markets in turmoil. And today I want to close out the week by talking about opportunities during periods of market volatility. My favorite example of this is in 2008, where Warren Buffett, he used his strategic cash reserves to make investments in Goldman Sachs. He helped fund a deal between, I think it was Wrigley and Mars. He propped up Bank of America, GE, several other companies at a time when many other investors were panicking and running in the opposite direction, running for the exits. And as a result, he made billions in profits during the financial crisis. Like, it was a tremendous time. Now, he had to see that through. It wasn't like a quick buck that he made. It took years for many of these things to pay off. And you may not be Warren Buffett, but it's another important reason to hold cash and be in a position to buy assets during periods of market turmoil. One of the best, most recent examples I can think of right now is in Portland. I live just outside of Portland, but the combined value of the 20 largest commercial properties in downtown Portland, so think large high rises, prior to the COVID pandemic, was, I want to say, $3 billion. You want to know what it's worth today, those same 20 properties, because of vacancies, the crime rate, homelessness, open drug use. The city is very poorly managed and they're failing in basic governance. And so a lot of the businesses that left during COVID simply haven't returned. And so rents are down, property values are down, interest rates are higher. I mean, I'm not exactly sure how this is going to work out for those property owners and for the city of Portland in general. Only time will tell. However, the current value is half of that. So in about 5 years, the largest commercial properties in the city in downtown Portland have lost half of their value. You want to know what I would be doing if I had a lot of money and could invest in commercial property in Portland right now? I would consider buying in, because there are tremendous deals to be had if these people are selling and if the right buyer comes along. But keep in mind, you have to have cash. So we're not Warren Buffett. I may not be able to buy any commercial property, let alone a high rise in downtown Portland anytime soon or ever. But there are still opportunities. And the key is having some cash available and being in a position where you are not financially strained yourself. And that's what I talked about yesterday, maintaining cash reserves, beefing up your bank accounts. You want to be on the prowl for opportunities because they're out there during times of volatility. What ends up happening in stocks during periods of volatility like we're having right now is that you have wild swings in both directions. So if you miss just a handful of the best days in the market during the tech bubble, during the great financial crisis, during COVID, right now, if you missed being in the market on April 9th, 2025, during the third best day in the S&P 500 ever, you missed out. If you were just fully invested since 1995 all the way through until today, a $10,000 investment in 1995, fast forwarding all the way through the end of last year, that $10,000 would be worth $224,000. But you know what? If you miss just the best 10 days during that time period, your $228,000 is now worth only $102,000. And what's most interesting is that the vast majority of those best days occur during the volatile markets. They happened during the tech bubble and the financial crisis and during COVID. And in periods of calm, that's only about 20% of the best days. 80% of the best days in the stock market happen during the periods of intense volatility. Now, of course, during the tech bubble, the great financial crisis, during COVID, the dominant volatility was in the down direction. But we have to keep that in mind because there are definitely opportunities to buy in, to add to your stock positions if you're not already overweight in stocks. So here's what I've been thinking about a lot and what I would tell a client And what I tell myself, because I'm very far from retirement, but I know most of you listening are older than 40 and you're much closer to retirement than I am. So if you're 3 to 5 years out from retirement, I wouldn't lose much sleep over the recent declines as long as you are well diversified in quality investments. And that's a big if. It's important to reevaluate your portfolio, make sure that you're not too concentrated in a high risk area because a lot of times, I mean, I've seen it where it's never come back. Okay. But if you are well diversified in quality investments, that risk is much, much lower. So you want to focus. If you have a few years left, chances are if you're 3 to 5 years out from retirement, we're going to be through the other side of however serious this downturn ends up being. If it's a mild correction and we turn things around, great. It'll be just a little bit of a hiccup. Even if it's a recession or a more serious down market, the likelihood is that if you fast forward 3 to 5 years out, we are in the recovery period. You want to focus on continuing to save. Do not stop saving in your 401k, maxing out your investment contributions in these last few years of retirement. Because if the market declines further from here and you're still adding to your portfolio, you just need to remind yourself that this too shall pass. And in all likelihood, by the time you get to retirement, your portfolio will have recovered. Even during the financial crisis, market dropped 50%. Most portfolios clawed out of that financial crisis 5 years later. And much sooner than that, if you were investing aggressively over that time. If you look at your portfolio value in like 2007 versus how long it took you to recover, for many people, it was 3, 4, 5, 6, 7 years, depending on how you were invested. But if you were adding to your portfolio during that time and not taking withdrawals, that recovery time was much, much quicker. So you want to be well balanced and still contributing to your retirement accounts over that time period, even if things deteriorate from there. And psychologically too, I think that can be helpful because at least you can be doing something. Now, I already talked earlier in this week ad nauseum about what you want to do. If you're already retired, if you're much closer to retirement, that's where the real risk is, because if we are in for a bear market or a recession that takes years to crawl out of, then you don't want to be retiring into the teeth of that. I talked about that previously, but I think until tariff policy becomes clear, you just want to be cautious about how you commit money. I think investing gradually and kind of keeping what you've been doing. If you're investing and adding to your investments every month, hopefully you are in your 401k if you're not already retired. I would beef up your cash savings in preparation for worse times to come. If we go into recession, you're going to want that cash. And if things continue to deteriorate from here and you personally are not impacted in a negative way, like you don't lose your job or something, obviously you're going to want to have cash for those kind of worst case scenarios. But if that's not the case, then you can use that excess cash that you've been building up to then take advantage of opportunities a la Warren Buffett. Okay, you can be your own personal Warren Buffett. But that's what I'd be doing. That's what I am doing. I'm always adding to my cash and making sure that I have enough because I want to use opportunities and dropped asset values in order to take advantage of that and add more to my investments, buy assets during a downturn. So there are still opportunities that exist today and opportunities that will come if the economy slips into a recession and stocks continue to slide. So keep that in mind. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.